Good morning. Well, the messaging is that they're going to hike interest rates to kill inflation. And that's a good message in the sense if you're worried about inflation. But history shows that this notion of a soft landing that Fed Chair Powell talked about yesterday is kind of more of a dream than a reality. Over the last 50 years, we've seen the Fed cause 6 recessions. Well, we can't really say they caused it, but maybe it's only a coincidence that we've had recessions after the Fed started hiking rates 6 times out of the 8 times they moved into tightening over the last 50 years. So it's good news. And there's a relief factor that it's only 50 basis points instead of 75 basis points. You know, kudos to Steve for a great question. But nonetheless, all right, the end game in this, if the Fed is going to beat inflation by raising rates, it's going to have to cause a recession to do so.
Well, hang on a second. Is there going to be a recession and high inflation because the Fed was asleep at the wheel when it should have actually been hiking rates, perhaps at a more moderate rate, to douse this economy? It should have been buying back these mortgage-backed securities and these treasuries in order to withdraw a bit of liquidity. Now it's panic stations, isn't it, Carl?
I wouldn't call it panic stations. I'd say that the Fed, as well as many economists, including myself, are surprised that year-over-year price increases have gone as high as they are. Many economists, including myself, and I suspect the Fed, and listening to Andrew Bailey, the Bank of England as well, they're wary that there are temporary supply factors that are going to, over time, work their way out, and that this won't become a persistent inflation. So I don't think they were asleep at the wheel. I think they were doing their job, which was being responsive and reactive to the data. And as the data evolved, they amped up their wariness about inflation, and they increased their actions to contain it. I think it was the right and prudent thing to do.
Yeah, you brought in Andrew Bailey. So, Carl, good morning to you. Let me throw a question at you from Threadneedle Street and the Bank of England. Clearly, the messaging has been fairly similar from the Bank of England. They feel that they need to take back this accommodation. But the reality, of course, is that the economic data on the demand side is deteriorating, as is the confidence data. Do you think it would be perhaps more prudent at this stage if they took a pause this meeting just to wait and see what happens next with the Russian invasion and supply chain constraints?
Good morning, Jeff. What a good question, because there are 2 ways to think about what the Bank of England and the Fed are doing. And for the point of view of the Bank of England, you know, what does the bank want from these poor people? Credit is already going down. Lending to businesses is going down. Lending to households is going down. What do they expect to do with higher interest rates? Make it go down faster? Since when is that a good idea? So I think that tightening to fight inflation in the UK, working with demand management tools, hits the wrong nail, all right, because the problem isn't that demand is growing too fast. The problem is that supply is short, and normally you'd look for lower interest rates to encourage investment to address that. Having said that, there is a case which can be stated clearly and makes sense under these circumstances for renormalizing interest rates. And we saw the bank move toward that kind of language in its last minutes. All right, interest rates are too low right now to be sustainable in the long term without causing problems. This is an opportunity to move interest rates back to more normal levels. And in that sense, I can understand what the bank is doing, although I still am critical that the timing is not ideal for raising interest rates right now, given what's happening on the demand side.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.